Josh, good to see you. We're going to dive into the headlines today with markets and geopolitics. When will stocks recover? Rising tensions in Iran have pushed oil prices higher and created short-term volatility in the markets. Historically, however, geopolitical conflicts tend to have only a temporary impact on stocks. Now, I want to talk us through what we're seeing. This is a chart from FinViz, which shows market performance over the past month. We do see a lot of red on the board. Why do we tend to see stocks fall first when tensions rise?
It really comes down to fear and people
Yeah.
reacting to the headlines, and people wanting to not be the last one out, or they just get fearful and want to sell.
hmm And now I want to talk about historical data, which I know you swim in this world. Not everybody does. But when we take a look at the S&P 500's historical performance, we see that the S&P usually recovers relatively quickly from geopolitical events. So this chart shows several events and mostly short, shallow pullbacks. Talk us through what we're looking at.
Yeah, you can see most of these pullbacks, minus Pearl Harbor, which took a while, but most of these pullbacks are short and shallow. Where you have with geopolitical, it's more about fear than it is about the actual strength of the economy, or are companies doing good or companies doing bad, all that sort of thing. It's more about people just get scared and jump out, and then they realize that, hey, it's not that bad, and get back in. So the pullbacks are normally fairly quick and not so deep.
Mm-hmm. For investors watching these headlines and rising oil prices, what's the most important perspective we should keep in mind before making portfolio decisions?
The big thing we want to keep in mind is keep in mind that these are long-term plans, and we never want to be reactionary.
Right.
We want to have a plan that's proactive, that's designed for your goals, your objectives, and your risk tolerance. Now, there's plenty of things that can be done during these times, where that's why dividends are important, and lower risk investments are important, so that when these times happen, if you do need withdrawals or you are taking monthly income, that's accounted for. And the big thing we want to remember is we all have short-term memories, and we think, oh, the last year was good, so it's always going to be good.
Right.
Or last year was bad, so it's always going to be bad. We have to have a plan that's good and works no matter what the economy does. And that's where you want to be proactive with your plan and be very purposeful with what your money's doing.
Right. When you have a plan, you are not going to make those knee-jerk emotional decisions. Explain emotional investing, Josh.
Yeah, emotional investing is probably the worst thing you can do.
Right.
Because you think about it, everybody gets excited when the market's on, going up, and they want to get in. Well, when that happens, it's already too late. It already happened. And the same people get fearful when the market's going down. And again, that's already happened. And you're actually doing the exact opposite thing that you should be doing. Warren Buffett's famous for saying we want to be greedy when others are fearful, and fearful when others are greedy.
Right.
And so these downtimes are actually a buying opportunity.
Right.
And the uptimes could be a selling opportunity. But when we think emotionally, we want to do the exact opposite, which is really the worst thing we could do.
Right. And it's just hard not to behave as a human when you're a human. But it again comes back to the importance of having a financial plan. So Josh, if somebody wants to create that with you, or even just talk through the volatility in the market right now, what's the best way to reach you?
Yeah, they can call us at the office at 260-488-8300, or schedule a meeting right on our website at millardfg.com.
Great. Josh, thanks for your time today. I appreciate it.
Hey, thanks, Erin.